Good afternoon, all. Welcome to the second in our series of the Tax Year End Masterclass. I'm Dominique Butters, and I'm one of your business development managers here at Blackfinch. Today, it's all about VCTs. Hopefully here to share some top tips, talk about how our Blackfinch Spring VCT is one to invest into, and I will be joined by Dr. Nic Pillow, who's one of our venture can't think of my words this afternoon, venture directors who actually looks after the money you give us to invest. Important information, this is obviously purely for advisors. This is not suitable for retail clients. If, however, you want some of the slides, they might be useful for you to use with clients, do let us know, because we just need to run it through compliance and we can put the right risk warnings on for you. So do feel free to ask if that would be useful. Now, it does not want to play. Learning objectives. This is CPD qualifying, so we do need learning objectives. By the end of this presentation, you will be able to outline the benefits investing in a VCT, especially this tax year. So we are talking about the next 2 months. Summarise how the Blackfinch Ventures team invest your clients' money. Identify the different types of clients who might be suitable for a VCT. And also know how you actually go about claiming the tax back on a VCT, because it is different for different people. So another way about Blackfinch, for those of you who aren't familiar with us, we're inspired by Charles Darwin in Darwin's Finches, hence the name Blackfinch. We're all about adapting, evolving, because if you adapt and evolve, you thrive. You know that better than anybody else as an advisor. That's exactly what you have to do. It seems like every 5 minutes with new things the FCA introduced to you. Bless you. So this is as well what we have to do to be successful. We've got over 30 years investment track record in the tax efficient space, and we've got just shy of £1 billion in funds under management. And yes, I am expecting a really good party when we hit the billion. We've got experience across multiple areas, including renewable energy, property lending, AIM, and obviously startup and scale-up investing, which is what we're going to look at today. And we've got nearly 150 people based across the UK. And we are a UNPRI signatory committed to responsible investing. Now, I know some of you might think, oh, clients aren't that bothered sometimes. But actually, I do think it's a nice addition when you're actually saying, well, also, not only are you going to get these tax breaks, but they are investing for good as well. Now, what do we have available at Blackfinch? Well, we have a range of tax-efficient investments, starting with our Blackfinch Adapt IHT service. That's the one that's unquoted or unlisted company, so it benefits from the 100% business relief allowance. So now it's gone up to that £2.5 million per person. Probably the standout points which my advisors use us for is they love the fact we've never had a negative period. And the whole time we've been doing it, 12, 13 years now. And, it's not been exciting, but it's never gone down. Most people who actually want these investments want something that's going to be really predictable. And that's what we have here with this one. It also helps with one of the lowest costed in the market as well, which means we don't have to take as much risk as others in the market to overcome high charges. We also have AIM portfolios. Now, funnily enough, since they've gone down to 50% relief, obviously from coming up in April, and also the fact the market's been all over the place and not in a good place, not as popular as it was. We are seeing a lot of people actually transferring AIM portfolios across to us into the Adapt IHT service to get that 100% exemption again. We are doing a special offer where we are actually doing no initial charge for all of those AIM transfers, whether it's ones held with us or from one of our competitors. Just so do speak to your BDM about that if that might be appropriate for you. The Blackfinch Corporate Management Service is another business relief plan, basically, but for corporates, for businesses. For those companies that have too much cash in their companies, they can actually, they could cause themselves to lose their trading status and become investment companies. But more often than not, when they've got surplus capital, they think they're going to get business relief, IHT relief. But actually, if it's not being used as part of the trade, they don't. It's deemed as an accepted asset by HMRC, and they don't get IHT relief on it. Now, you're normally probably saying to these business owners, take it out, pop it into your pension, perhaps later pop it into a VCT, we'll talk about later. This particular product, those people say, no, I want to keep it in. I might need it. I might buy another business. It's often their comfort blanket. Well, basically, we can trade that money and get their IHT relief back, sometimes immediately. In fact, most times immediately. So if you have companies with too much cash in their company, do come and speak to your BDM. We also do EIS portfolios, and I have a specific webinar on that one on Thursday at 4. Hopefully you can join me on that one. So it'll be everything about EIS, and it is actually managed by the same team that do VCTs, who we're going to hear from later today. Lastly, we have also, which surprises a lot of people, we do actually do what I like to call normal everyday investments as well through asset management, and we offer managed portfolio services. But we also, in non-fund manager speak, also offer a tailored portfolio service. In my head, it's a little bit like MPS, but on steroids. And that's because we work with you as the advisor, as the firm, and we say, okay, in an ideal world, how would you like your MPS to be run? Exactly what would you like it to include? So actually, we work with you and literally tailor it to you and your client's needs. So when you're reviewing your centralized investment proposition, do think of us. We'd very much enjoy having a chat with you. Even if it's a box ticking exercise to say, actually, what we have already is perfectly suitable, but we might surprise you. So changes to VCT tax relief. So some of you may not have picked this up because, funny enough, she didn't make a big song and dance about this at all in the budget. But in last year's budget, VCT tax relief is going down from 30% down to 20% for the new tax year. So that's rather annoying. The only upside, though, is this year, of course, make hay. So a lot of my advisors, where they would normally invest 10, 20,000 or so into a VCT, clients say, okay, actually, let's do 50 this tax year. Let's maximize it on that 30% tax relief, and we'll think about next year when it comes round. So actually, we're seeing this year is going to be a really bumper year for VCTs. So make hay while you can. Now, come next tax year, do you want to invest now when it's only 20% tax relief? Well, actually, to be fair, the reason why it's gone down is they have changed the rules, which does mean it is going to be so much easier for us to invest in more established companies, bigger companies. We can put more money in. Therefore, the risk should decrease as well. So actually, if it's less risk, well, you should have less tax relief. So what you might find is actually VCTs will become more appealing to people because they will be deemed as lower risk. The FCA will probably still categorize it as high risk, but actually they will be going into bigger, larger, more established companies. So you should see less failures. Now I'm going to pass you over for what I'd like to say the really interesting bit now, which is with Dr. Nic Pillow, and he's going to take you through how we actually invest your money when you do decide actually the Blackfinch Spring VCT is exactly where you want your client's money.
Thanks, Dom. So I'm here to give you the inside view of what's going on in the ventures investment team. First of all, the chart there is showing the type of company that we want to invest in. Companies that don't grow nice and steadily like those IHT safe assets. These are very exciting companies that have the potential to scale up very quickly. In our case, they are technology companies, or at least technology-enabled companies. But I should stress there is, of course, that balance between that exciting return potential and risk. And for that reason, we very much avoid the very early stages With our EIS, we start to get interested at that middle stage. But for the VCT, we're looking on the right-hand side there, companies that have already proved there's a market for what they want to, or what they are selling, that they can deliver it. And they've got all the elements of the team to sell, to support customers, to continue development, and they need more resources to continue doing more of what they are already doing. And as Dom has just mentioned, with the relaxed rules from the government in what we're allowed to invest, we can actually push that up even further to the right in a bit beyond the next tax year. So that's where we still have that potential for good returns, but with a lower level of high risk than there is earlier on. In terms of who we are, we have a team now of 12 people, and we've got a really nice mix of experience. People with technology experience, finance experience, and direct startup experience. So in my case, I did a PhD many years ago. I worked through a series of very successful startup companies. I ran my own for a few years, and about 6 or 7 years ago, I joined Blackfinch, moving over to the finance side, having raised money for my own company before that. And similarly, Richard Harley, ran a very successful company of his own. Whereas Kim Hay, in the center there, who leads on our new deals, got a very good background in mergers and acquisitions, which is then really good when we want to get exits for our companies. So we have that finance experience, the startup experience, and 3 of us have engineering PhDs. So we are not at all fazed by some of the exciting technology that's coming along in the world now. And it's not just us. In addition to the ventures team within Blackfinch, and of course supported by all the other teams within Blackfinch, we have an external network of what we call venture partners, people with real business experience, been there and done it, and we think will add real value to the companies. And we appoint these people to the boards of our portfolio companies after we've invested. And they can be people like Geraldine Osman here in the middle, who founded her own company, took it to the US, sold out to private equity, and is brilliant at marketing and really helps companies who need that extra help, not just in board meetings, but outside too, and really get up and running on the marketing side. Or someone like Libby Chambers on the right there, who is on the board of one of our fintechs I'll tell you about in a little bit. And she's also on the boards of TSB and Wise. She is intimately involved in that sector and brings huge domain expertise to the board that she is on. So they add real value, as I say, when we've invested in companies, in addition to the work that we do within the team to support the portfolio companies. At which point, I should probably tell you the process we go through to invest in companies. And I mentioned that the team and our diverse experience, and that would be nice anyway, but if we all worked individually, that wouldn't help so much because we can't sort of mix it up, but we don't. We work very much as a team, and therefore these stages are very structured. We are discussing as a team, do we like this company enough to move it on to the next stage, and we know we've got to do a certain amount of work on companies, and then we're going to say no. But is it good enough to move on to the next stage? And we discuss that and debate that internally. We were doing that again with a set of companies just this morning. And that makes it a lot more objective as well than in many cases. If, for example, I were just to go off and find my own companies, and then perhaps I'd get that sort of bias because I like the founder and I want to push it all the way through. And that we're really trying to avoid that. And we see a lot of companies, we get them, through connections with universities, research hubs, startup accelerators, where you get lots of startups all coming together, getting advice and help, from referrals, sometimes from financial advisors, but very much from other investors, from our networks, from founders, from our venture partners all over. We tend to see over 1,000 companies a year, and last year it was actually more like 3,000. we obviously get all those companies coming in. We go out looking for them as well. We have a research tool that helps us find these companies. So we really do have a lot of companies coming in at that very early stage. And then we can filter down the ones that we think are really good. And I won't talk through all these stages in the interests of time today, but just to highlight another one, that's stage 3 with a pitch. I think that's quite sort of central for our process, because founders are pitching to investors all the time, and they're really good at making a nice glossy story, for maybe about an hour. And that's why we typically have pitches of at least 3 hours. We've done quite a lot of work to qualify companies already before we get the pitch, but this is where the company will present to us and to multiple senior members of the team. And then we'll ask all the questions and we'll drill down. And quite often you've sort of got, oh, this is really good at the start. And then you start chipping away at things and it's like, okay, so let's get this sort of more realistic picture. And sometimes they're still actually really good. We know those, early stage companies perfect. By definition, they're a work in progress. But in other cases, you think, okay, no, there's just too much, still to be done here, for the valuation that they're asking for, and we'll throw them out at that stage. But it helps us build good rapport with the founders as well, because there comes a point, although it's quite sort of grueling in some ways to have this sort of intense session for quite so long, they really get the idea that we understand what they're going through. Again, drawing on our own experiences as founders, and they can see that we are actually devoting significant senior time to their company to really try and understand it. And that's usually when they then sort of open up and give us the full picture, and we can get a really good understanding of what's going on, but also a good relationship to take through to the later stages of the process, and of course then into supporting and monitoring the company for several years to come. We target our target holding period is between 4 and 7 years. So and we have no way of coming out early. It's when the company reaches a sale, or some equivalent exit, that we can get the money back out for the VCT. And how is it going so far? Well, just waiting for the slide. There we are. We launched the VCT with the first shares March 2020. You might remember, just as the country descended into lockdown. And I'll be honest, it wasn't the timing we'd have chosen if we'd had the choice with hindsight. But that's how it was. And of course, we'd made no investments at that point. And so, like any VCT, or at least any successful VCT, we embarked on a bit of a J curve. And the NAV initially drops down because we're carrying costs, but we haven't got investments to grow. But we start making investments. We continue raising money. We get to the £20 million in September 2022. And the NAVs drop to 89 pence. But then it starts pulling up again as the investments we have made increase in value. We start paying dividends, which of course is really important. We couldn't pay dividends as a new VCT, but we've now paid 2 full years of dividends. We paid 10.3 pence so far, at a yield of just over 5% a year, which was our target. And we have now declared our next dividend, which will be 2.5 pence, eligible to everyone who invests before the end of the tax year, and that will then get paid in about the middle of May. And so up to the point of the last sort of published report, we've got the half-year report for last year and our current prospectus. We had £64 million total assets. You can see substantially up on that 3 million we got by March 2020. And our NAV plus the dividends up to 106.7 pence, which is obviously very encouraging growth from where we started. But the good thing is it's also quite a long way short of our performance fee hurdle of £1.30, and that means there's another 23 pence or so of growth to come in that NAV plus dividends before Blackfinch will start earning any performance fee. we will only earn it for increases above that. It'll be 20% of increases above £1.30. But as I say, a good amount of increase still to come before we would start to earn anything. So shareholders will get that full value of any increase. That shows you slightly more, specifically quarter by quarter what the actual numbers are, and you can see how in that darker color at the top on the right, increasing amounts of the value being returned to shareholders as dividends, and the total returns on the left there. It's always never on the VCT look at the 1 year. That doesn't really help very much, but you can see the 3 year. When we'd got going and we've been going well, actually, a very, very respectable, total return figure there on the NAV. And in that time, we have built a portfolio of 39 companies. We're not quite showing all those in this chart because, again, this is at the last published report. But at the middle of June, you can see there the split of our investments by different sectors. Really important for us that we get very wide diversification. It's a long time since technology was some small niche sector on its own. We have companies across things from in the bottom left there, health and well-being technologies, so helping older people at home, for example, to companies sales and advertising technology, so companies powering the sort of digital e-commerce economy. To much more physical things like construction technology. So really wide range, really technology impacting all areas of the economy these days. And I want to then just give you a couple of specific examples. And first one is currency, one of my favorites, and it's the fintech I mentioned earlier. And if you go abroad, get one of these. I don't know if you can see it there in focus. It's a currency card, and it's a travel debit card. It saves you all the extortionate bank charges and marked up exchange rates that you get with typical banks. And you might say, well, big deal, there are lots of those, and there are. But this one is so much simpler because you do not need to transfer money into a separate account. It links directly to your high street bank account, and it is just like spending money from your own account with your own card, except you don't get all those charges. It is so easy to set up. Really, very well worth getting one. However, from an investment point of view, what's really exciting is that the same technology that allows it to link into any bank means they can offer another product, a loyalty debit card. And they started with Hilton Hotels. So if you get the Hilton Honors loyalty debit card, that comes from currency. And much more recently, at the end of November, they also launched an equivalent card with Marriott. So the Marriott Bonvoy loyalty debit card gives you brilliant points. And the number of cards they're getting through these schemes is going up very, very fast. And they're getting a lot of interest from other big international companies that want to offer these loyalty debit cards, and they are the only ones who can do it without needing you to have a separate account to pay to link to the loyalty program. So starting to be very successful there, and we have high hopes for currency in the year ahead. And talking of high hopes, I think my other example here is SpaceFlex, which is a space technology company. And what SpaceFlex does is to monitor what is going on in space around the Earth. There are thousands and thousands of satellites now in particularly low Earth orbit flying around unbelievable speeds. In fact, I think I saw a report in the last week that Elon Musk now wants to put a constellation of 1 million satellites up there. And so it's getting a lot more congested. There's also a lot of debris flying around, and the smallest little piece crashing into a satellite would destroy it. And what SpaceFlex is able to do is track everything down to as small as 2.5 centimeters across, at whatever speeds it's going around the Earth, and it can sell that data. Then it does sell that data to commercial satellite operators who obviously have an interest in keeping their satellites safe, but also to governments, at least friendly governments, who want to know exactly what else is going on up in space. I hadn't realized it was quite so aggressive up there, but apparently there are essentially spy satellites moving around, getting very close up to other satellites all the time, having a look at what's going on. And you can imagine that governments are very keen to keep a very close eye on what's going on. So Spaceflux has this network of satellites around the world, network of telescopes around the world based on the ground, but able to monitor what's going on up there. And since we invested last year, they've already won a very large contract with the UK Space Command Centre. So, again, a company with very high potential. And with that, I'll hand back to Dom.
I didn't think my mouse was going to work then. Thanks, Nic. I really appreciate that. So why invest in the Spring VCT? Well, hopefully Nic has actually told you lots of reasons why exciting companies. It's not just the fund managers who are helping these companies, but those other founders as well, those experts. And I think that's what really brings it to life, the actual whole investment. And I think that's actually also why we actually win. Like, take Spaceflux, that was so competitive to get into, but we did. And that's because one of the people we actually worked with, well, I don't know if I'm allowed to say, but it was very high up in government things, so really understood this. And we worked with them and they went, actually, wow, your contacts, yeah, we want to work with you. So whereas really we shouldn't have got a look at on something so massive and amazing as that deal, we did because of our team, their expertise, and the people we work with. So I think that really differentiates us from others. Other reasons, I think, is Nic mentioned when we launched, it was a nightmare, March 2020. Can I just say, trying to get people to actually invest in a brand new VCT as the world was, going to hell in a handcart was not the easiest task. But as it turned out, wow, how fortunate was it? Because, of course, with a VCT, like Nic said, you don't have to invest straight away. And guess what? We didn't. We sat on our hands and thought, let's see how this plays out. So unlike a lot of VCTs out there, and you might have investments in there and clients in them, which are really struggling, having a terrible time, well, they've got investments, what I call legacy rubbish in there, ones they would never have invested in if they knew what was going to happen. And so I feel quite sorry for them. We're really lucky because we've invested in these companies in this new world. So we're really lucky. And that's probably, again, why we're one of the top performing VCTs. We don't have all those legacy companies in there we wished we never had. Now, that's not to say we're not going to have any companies fail. Of course we are. But we knew what the world was like before we invested in these companies. And that's a big advantage. Also, as Nic said, we are paying regular dividends now. And also, of course, the potential for special dividends. So when we sell out of one of these wonderful companies, a big lump of cash comes into the VCT. And under VCT rules, you do actually have to pay out the majority as a tax-free dividend. So there's really good potential there for special dividends with this VCT. Also, that high hurdle for performance fee, it just means your clients are getting more of the return than they would be if they're in an old VCT who's already probably hit that hurdle if they had one to start with, and they're taking their performance fee on every pound they make. And obviously, we've had that strong performance. Now it's gathered pace. Now those companies are building. We're really seeing exciting things happening. But you're still buying at quite a reduced price, really. And that's because with a VCT, you don't only just look at how the companies are doing, you actually also have to look at what the equivalent stocks are doing in the listed market, and they're quite down historically. So actually it brings the valuation of our companies down. So you are buying at quite a discount, this VCT as well, really. But it is also nicely diverse. So you've got a nice spread of investments. You're not just invested in one tech, because if one thing hits one sector of tech, you're taken out. This is lots of different sectors, as you saw in that pie chart. So it's really well diversified. Now, here's my computer going to play. We'll see. Right. So what type of clients? I like to say who, what, where, and when to use a VCT. The first one's probably the most popular one is with company directors. They've often got surplus capital in their company. In fact, you might be one yourself where you often take tiny salaries to use up your personal tax allowance, the rest in dividends to use up your basic rate tax allowance. Say, I'm not taking any more because I don't want to pay higher rate tax. Okay. But it can cause issues because, of course, spare capital in the company, as I said earlier, may not get IHT relief. Money in a business is always at risk. Now, you will see those clients say, come on, let's stick it in your pension. Well, they might have enough in their pension now, especially if the pension change is coming in April 27. So they might be saying, I think I've got enough in there now. Well, actually, what about taking it out? And we'll look at a case study on that in a second. Landlords. Now, landlords are a good one because actually, of course, they don't have net relevant earnings, so they're a bit scuppered on pensions. So VCT could be a good alternative and provide them, of course, tax-free dividends, tax-free income stream in retirement. And they could get all their money back on their rental income, so they basically get their rental income tax-free. Got an example on that one as well. High earners, this one's always been a good one. You've done their pension, you've done their ISA, now what? Well, maybe a VCT as part of an overall diversified portfolio. I mean, one or other investment can go down by up to 30% and they haven't actually lost any money. So again, a VCT as part of a portfolio could again work with those high earners. So the big one we see now are those people, though, who are thinking, well, I've got this big pension. It was going to be an IHT plan. That's not going to work so much now. So I'm not going to put as much into my pension or else I'm going to stop. What else can I do? Well, a VCT, again, could be a great alternative for those. And then retired clients. Now, they don't pay much tax. However, if you said to them, well, do you know what? If we just moved a bit of your money from the Building Society or National Savings each year for the next 5 years, we can make you a non-taxpayer and give you an additional tax-free income. How does that sound? I think that a lot of them would bite your hand off because if you ever want to eat your cake and have your cup of tea in peace, just ask a pensioner how they feel about paying tax in retirement. Brilliant. They'll rant for at least 10 minutes. You can have your cup of tea in peace, eat your cake and go, well, should we get that back for you then? Honestly, they'll think you're marvellous. Again, because they don't pay that much tax, you're probably only doing 10, 15, 20,000 pound VCT a year, but you're massively adding value to that client. That client's not going to go anywhere. So if you've got £500,000 or £1 million into funds under management, actually a lot of my advisors do this VCT just as part of the annual review and say, do you know what? I'm already charging you 0.5%, 0.75%, 1% on an ongoing basis. I'm going to do this business for free. Of course, you could charge, but talk about adding value because you're the advisor who's making them a non-taxpayer, and do they ever appreciate it? So let's look at a company director. So this is an example of somebody taking out a dividend. They're going to use part as an income and part they're going to put into a VCT. Fine, get their tax back. What I want to draw your notice to, though, is down the bottom right here on the tax reliefs, because what we've got now is your 30% tax relief this tax year, and also the dividend rates, because of course dividend rates are going up by an extra 2 percentage points come April. So at the moment, at higher rate tax, they're going to pay 33.75%, go up to 35.75% next tax year. So take as much out as you can this tax year at the lower dividend rate, put it into the VCT at the highest income tax relief rate. It just makes sense. And whenever I've met company directors, when they said, oh, I haven't taken it out because I didn't want to pay higher rate tax, my first thought is to say to them, well, okay, but if we could offset 30% of it, so your effective tax rate is 3.75, what do you think then? Without exception, they'll go, oh, I don't mind 3.75. It was the 33.75 I wasn't so keen on. Brilliant. And basically, it's just a 5-year exit strategy. They're getting cash out of the company tax efficiently. And of course, they can always put a little bit more money in from savings, premium bonds, and offset all of the tax. They're not limited to how much they've taken as a dividend. They can put as much as they want in. They just can't get back more tax than they paid. That's all. And what about VCTs for landlords there? So if you do have landlords whose main income is from rental properties, basically, look, they could be paying tax at 20%. The fact that they can invest money and get 30% tax back, they're already thinking this is fantastic. So take this example of Mrs. Bailey earning $50,000 a year. Income tax at 20% is just under $8,000. She only actually has to invest half of that $25,000 of her earnings, at 30% tax relief to get all of her tax back. Sort of what's not to like, really. And of course, if you do it each year, and I've got a slide on that as well, she could be getting all her rental income completely tax-free and tax-free dividends to boot. So this is my favourite slide, and this is one that often advisors want to use with their clients. So just let us know and we can badge it up appropriately. But this is my conveyor belt slide. So in an ideal world, if you've got a company director, landlord, retired person, whoever, you say, okay, this is a 5-year strategy. Let's invest in a VCT for the next 5 years, because come year 6, you only have to keep a VCT for 5 years to keep that tax relief. So we're going to pull the first VCT out, reinvest it into another one. It does have to be a different VCT now, or you have to wait 6 months. The rules are you can't invest in the same VCT either 6 months before a withdrawal or 6 months after. So you put it into another VCT, get another lot of tax relief on the same money. Year 2 does year 7, and so on and so forth. It's really useful. Now, obviously, it's going down to 20%, but even so, 20%, they're a 40% taxpayer, they're still getting half the tax back. And don't forget, it should be lower risk as well. So I do think this year's going to be a bumper one. I think next tax year, we might have pinched all the money they were going to invest next tax year in this tax year. But then I think the following year, it'll be back to normal because it's still getting tax back, and they're still getting tax back every 5 years on the same money. Well, actually brings me on to pensions, because I mentioned about people say they're thinking, oh, I don't know if I'm going to put, more money into my pension now because of the tax changes. You'll also get those people who say that now, who only got £2.50 in their pension. You go, no, you still need to do your pension. This is a really good vehicle. And they're saying, well, what's the point? I might get tax relief on the way in, but they're going to tax me on the way out. What's the point? Well, this is where you could say to them, well, how about you invest in a pension, you get all the tax relief of a pension going in, it grows completely tax-free, and we get it out tax-free at the other end. They're saying, sorry, what was that? How'd you do that? Basically, do a VCT alongside. So they're doing the pension, they do a VCT, each year for 5 years, then you've got your conveyor belt. Then at some point they'll retire, or they sell their business, no longer taking dividends. But you've still got this VCT. So let's say it's that 50,000 in there. You reinvest that 50, you get another £10,000 of tax relief, but they've got no earnings. You say, well, no, hold on. How much can we take out of your pension? Take a lump out of their pension, create a £10,000 tax liability, because this is going to offset it. And you can do that every year until they've got all of their money out of their pension completely tax-free. So bizarrely, a VCT is a really good alternative to a pension, but also works beautifully alongside one as well. Now, but I am a great believer in just not telling you all the benefits of investing in a VCT. You also need to know things that could catch you out, and also making sure you know all the hiccups that can come along the way. So first of all, you can only offset income tax in the current tax year. If you want to go back a tax year, that's EIS. I'll be covering that on Thursday in my webinar. But VCT is current year only. It's also an income vehicle. It's not a growth vehicle. So when we say, oh yes, you get tax-free dividends and tax-free growth, and most people are used to having investments that grow, and their dividends are a little bit icing on the cake. With a VCT, it's not. You actually get the returns through those tax-free dividends. So if you've invested £10,000 into a VCT, at the end of 5 years it's worth 9, don't be surprised. Whereas your client, if they're not prepared, they go, well, that was a rubbish investment, wasn't it? I put in 10, I'm only getting back 9. Add back in all the tax benefits you've had, all those tax-free dividends, then look at it. Oh, I see. It's that 10,000. Actually, I've had 5,000 or £6,000 back in tax-free dividends. Exactly. So actually with a VCT, it's not a growth vehicle. You could well get less back, but you've had it paid out as those tax-free dividends. It is one of the rules of a VCT, actually. So very rarely, and if you do get growth, it will be small because it will have been paid out as tax-free dividends. You can't get back more tax than you pay or due to pay. So again, someone say, oh, I put £100,000 in. Brilliant. But only if they're paying £30,000 of income tax in this tax year, or they're due to. If they're only due to pay £20,000 of tax, they can still invest 100 and they'll get tax-free dividends on the 100, but the tax relief will be restricted to that £20,000 of tax they paid. Now, they might want to put in 100,000, they love the vehicle, so they'll take more out of their pension and create a tax liability, or out of their company. That's absolutely fine, but they can't get back more tax than they paid. But unusually, you can claim all income tax back. So that is earned pension, savings, dividends, rental income, even chargeable event income tax if you sell a bond. So if you have got people with old bonds, perhaps coming up to the 20 years, they've been taking that tax deferred income, or it's an old policy with really high charges, and you're thinking, well, the bond is the right place, but really I could do with getting out of that one and putting it onto a new charged one, or it wasn't on a multi-lives assured basis, so we can't do any post-death tax planning. In an ideal world, I'd like to cash that one in and reinvest it again elsewhere. Well, don't forget, income tax is still going to be charged on death on a bond. And if it's not on a multi-lives assured basis, not a lot you can do about it on death, i.e. nothing. Whereas during their lifetime, sell the bond, give rise to that tax charge. Right, how much is the tax charge? Let's say it's £3,000 of income tax. Well, you could put 10,000 into a VCT, potentially EIS, offset that £3,000 of tax, and you've just released the rest of that money from the bond to invest elsewhere. As I said, it could be they want to do IHT planning, so it's going to go into a BR plan, preferably with Blackfinch, my Blackfinch Adapt IHT portfolio. But no, in seriousness, they can reinvest it in whatever they want. It could be back into the same bond or a different bond, multi-lives assured basis, but you've rebased it at that higher level. But at least they've offset that income tax, so there's less to pay on death or less to manage out at that time. So how do you actually claim tax back with a VCT? Actually really simple. When we do the EIS webinar, bit more complicated. But with a VCT, you get issued with one certificate, normally just a couple of weeks after we allot the shares. For those people who don't already do a self-assessment tax return, so employed people, pensioners, they don't do a self-assessment form. They do not now have to do a tax return just to get their tax back. They can if they want to, no need at all. They literally just send their VCT certificate in with a covering letter to say, I've done a VCT, please give me back my tax. Simple as that. And they will receive a check back in the post, or if they give their bank details, it can go straight into their bank account. If they're investing part way through the year and they want to they can change their tax code for the rest of the tax year. So, for instance, when I was doing quarterly, investing in VCT, I might invest at the end of April. I'd actually write into HMRC and say, I want my tax back. And they would actually change my tax code. So I'd actually get my tax back each month when I would have been due to pay that much tax. So you can have a change in tax code, or if you've already paid the tax, you just get it back in a lump sum. For self-assessment people, dead easy as well. On that first questionnaire where they're completing name, address, etc., one of the questions is, have you invested in a VCT or EIS and want to claim the tax back? Check the box, say yes. Get another form comes up, says, have you invested in a VCT this tax year? How much? Literally in the box, you put in £10,000 and it automatically calculates it either offsetting tax you might owe them or a tax refund. Literally as simple as that. There is nothing else more complicated on claiming your tax back on a VCT. For company directors, of course, they've taken an extra dividend out. They're due to pay the tax, but they've got a certificate. So they say, well, I'm due to pay this tax. I've got a certificate. I'm not going to. Simple as that. One offsets the other. They can even offset their payments on account as well. That's a form SA 303. So say they're investing now and they're due to pay 31st of July. They just give the certificate to the accountant, say, oh, yeah, can you just offset that against my payments on account? Absolutely fine. So claiming back the VCT, really simple, really easy, really straightforward. One other point on here as well to mention, obviously you need to keep a VCT for 5 years to keep that tax relief. If, however, you die, HMRC don't blame you for that. It's not your fault. If you haven't already claimed the tax back, your executors or your estate can. That's absolutely fine. And they don't ask for it back. So on death, obviously your beneficiaries or spouse can actually have the VCT transferred to them, or they can sell the VCT, which I'm going to come on to. They could even reinvest it again themselves and get another lot of tax relief. Absolutely fine, no penalty, no having to pay back that income tax relief if they die within the 5-year term. So, how to sell a VCT? Now, if you're not used to VCTs, this one's important because they don't mature. It's not a case of saying, oh, dollar done for 5 years. Yeah, can you cash it in now? Doesn't work like that. A VCT is basically a PLC listed on the main stock market, and that's what you're holding shares in. So when you want to actually sell it, there's 2 ways. One is a buyback, and that's when the VCT itself, the VCT company, buys back the shares from investors. Or there is a secondary market. However, the secondary market is hopeless. And the reason it's hopeless is because people buying second-hand VCT shares do not get that initial 30% income tax relief, or 20% in the new tax year. They don't get that. So, of course, what they want is to buy those shares at a heavily discounted price to make up for it. So actually, one, there aren't that many buyers on the secondary market wanting to buy second-hand VCT shares, because why wouldn't you want to get the income tax relief? And secondly, it'd be at a big discount. So what you're looking for with a VCT is that they do offer a buyback and that they have done buybacks, okay? So most buybacks are usually at a discount to the net asset value, the NAV, of usually between 5 to 10%. Now, what I will say is That's not a money-making scheme. It's not an exit penalty or anything like that. It's the VCT company itself saying, right, well, if we buy back those shares, we now have to list them back on the LSE, London Stock Exchange, and it costs quite a lot of money to do that, which is why you have that 5 to 10% discount to NAV. It's to make sure it covers the costs and other investors aren't paying the price and aren't covering those costs. Okay. We charge a discount at 5%, and that's literally just to cover the costs. It's not to make a profit. But again, you need to be aware this is not happening every day. It's not even happening monthly, probably 2 to 3 times a year. So you need to actually register interest. You want to sell your VCT with the company. They'll then actually normally put you in touch with the broker they use. You go to them and say, right, I want to sell. And you do actually have to have your own broker. If you don't have your own broker, and probably 95% of clients don't, they'll just say, oh, you can use X, Y, Z. And the cost is normally around £50 per VCT. Which also brings me on to another top tip, actually. A lot of people, especially when you're new to VCTs, will say, oh, my client is investing £50,000. Oh, these are really high risk investments. I'm going to diversify across 5 different VCTs. Okay. One that's given you 5 times the amount of work to do in a recommendation. Okay, but well done you for, prepared to do it. 5 times a lot the reviews to do for each VCT each year. But actually the devil is at the 5-year point. When you now want to reinvest, you're now having to reinvest 5 different VCTs, which will all have different buybacks. They'll all have different processes. They'll all need brokers. And all of a sudden, that £50 per VCT is now £250. That's not great. And they're all going to be doing it all different times. It's going to be a right pain. So what I tend to suggest to people is with a VCT, pick your favourite. Do that one that year. The next year, you're going to do a second one. Do your second favourite the second year. In the third year, if you've got another one that's favourite, fine, do that. If not, go back to your first one that's favourite. Do it in year 3. And alternate perhaps your top 2. Because then in year 6, you're going to sell your top favourite. Say that's Blackfinch. You sell that one and you're going to put it into your second favourite. The next year, you're going to take out your second favourite and put it back into Blackfinch. So what you're doing is alternating and keeping your best 2 VCTs. It reduced down the costs, it reduced down the paperwork, it reduces everything down. And VCTs, by their very nature, are actually still diversified. I know some of the old ones are not looking so good at the moment, but look at the newer ones that don't have those legacy companies in there, like the Blackfinch Spring VCT. We do also have our own guide for the process on selling a VCT back. So we have that. We have a policy. We give you all the contact names and numbers, and we can help you with that. To be honest, once you've got it through it once, it's actually quite straightforward. You just do need to register interest, though, and don't please say to a client, oh, yeah, I'll get that back for you, have it in a couple of weeks, as if it's a normal investment, because it really doesn't work like that. And Nic actually stole my thunder. We have actually just declared that we are going to be paying our latest interim dividend of 2.5p for everyone on the share register by the end of the tax year. So if you're investing this side of the tax year, you will get that 2.5p dividend, and that's going to be payable on the 15th of May. Now, learning outcomes. I am hoping now at the end of this hour, you can outline the benefits of investing into a VCT, especially this tax year. Make the most of that 30% tax relief. Summarise, all right, you're not going to be as proficient as Nic, but how the Blackfinch Ventures team invest your clients' money. So again, you can explain those venture partners, the fact our own team have been founders, and what we're really trying to do in growing those little companies, but actually a bit further up the life stage than you probably thought they were. They're a lot lower risk than the EIS companies, but really taking them to that next stage, very exciting growth. But also, hopefully, you can now identify the different types of clients who may be suitable for a VCT. And of course, now know actually how to claim tax back on a VCT as well. Now, we really do appreciate your feedback here at Blackfinch. If you can hang on at the end of the webinar when it finishes, there will be a very short feedback form to complete. I promise it takes less than a minute to complete, but we really do appreciate having your feedback because that's actually what helps us actually build new webinars in the future. But it just leaves me to say thank you so much for your time and attention this afternoon. We really do appreciate it. If you are one of my advisors in the Southwest, then obviously you have my contact details there. And obviously Georgia, my right-hand woman in the office, who's always there to answer your queries and questions as well. But please do reach out to us. If you would like a copy of the slides, do let us know on the feedback form. We're happy to give those to you. But just a reminder, of course, these are not suitable to share with retail clients. If you want any for clients, just let us know and we'll make sure we adapt them appropriately. But thank you so much indeed. Until the next time.